As we've already touched on, the revenue 29.1 billion, forecast 29.7, EPS 78 cents, forecast 184. Of course, all of that is backward looking at a time when looking backwards is less relevant than ever. The one key factor in this quarter's release, which is booked in the past quarter despite being based on forward-looking estimates, is credit costs. How much of the loan book that the bank has is the bank now fearful might not come through in the future? That came in at 8.3 billion, provision for credit losses. Now, the range of analyst estimates that was out there, huge ranges this quarter on every single line item, was 1.5 billion to 25 billion. That was one outlier of an analyst. The median was 4.7 billion, and it came in at 8.3 billion. Last year, that number was 1.3 billion, and it included a significant reserve build of 6.8 billion that Becky was talking about, which, of course, significantly lowered the EPS and is the reason why the EPS is below expectations. But an 8.3 billion number versus 1.3 last year, a median of the estimates of about 4 billion, but well below the worst estimate of 25 billion for how bad the loans outlook is going to be. We really need to listen to the commentary on the call about that's the key thing everyone's been looking at. In terms of the text on that point, Jamie Dimon said the reserve build is due to the likelihood of a fairly severe recession. Again, nothing new in terms of what we'd expected on that front. Now, a couple of other things just to focus on that are also sort of new that we were looking out for, and that's trading revenues, which is a strong beat, a big jump there, as again we might have expected. We saw fixed income, commodities and currencies trading 5 billion, that was up 34%. Equity trading 2.2 billion, that was up 28%. Investment banking revenue, on the other hand, was down 24%, again, as expected. So what are the other key things we're thinking about as we go forward now? JPMorgan, always been the standout in terms of return on equity. The same quarter last year, return on tangible common equity was 19%. This quarter, 5%. Again, giving a scale of the level of returns that these banks might be able to earn going forward. Still positive, but significantly low, about a quarter of the levels it was this quarter last year. Costs came in perhaps a little better than expected. Again, we're only talking about up to the end of March. The efficiency ratio stated at 60%, but on a managed revenue basis, 58% is only a little bit higher than expected. But we'll have to see whether costs continue to tick up. The key point, though, credit costs 8.3 billion. The same quarter last year, 1.3 billion.